long-term versus short-term cycle trading in crypto. Which is right for you? That's what we're going to talk about today on Crypto Intel. My name is Max. And stay tuned to the end because I'm going to show you why you can do both in a safe way and in a way that can make you some good returns. Let's get started. So long-term versus short-term trading in crypto. Let's first define again what short-term trading is versus long-term. So when we're talking about long-term trading, what we're talking about is trades that last for at least a whole cycle. And in Bitcoin, a cycle is really 4 years long. So you have an uptrend for a year, a parabolic uptrend for a year. You have a downtrend for a year. You have a year of transition, and then you have the start of the uptrend again. So that's your long-term. And long-term trading is the most effective because it takes the least amount of emotions to do it. You can just dollar cost average. You can just average in every week a certain amount of money and just play the long-term trend. But if you want to do short-term trading, then what you have to do is look at a number of different factors. So let's take a look at that. Now, a lot of people want to trade short-term because what they want to do is trade for a living, all right? They have a dream of, quitting their job, of having their trading pay all their bills. But the problem is that when you try to trade to pay bills, if that is your only income is going to be trading and you're just starting out or you're not a very experienced trader, emotions are going to play much too big of a role. So the better way to do it is not to, if you're going to do short-term trading, not to think about trading to pay your bills on a weekly or monthly basis, but really to bucket your capital so that you can do your trading, your short-term trading, without emotions. Now, what do I mean by bucket your capital? Well, this is what I'm talking about. Let's take a hypothetical. Suppose you have $100,000 in capital and you have a job. Now, your goal is to quit your job and to trade for a living. So what are you going to do? Most people think, well, I'm going to take that $100,000. I'm going to start making trades every day. I'm going to make, $1,000 a week or, $500, whatever amount you want to do. You set a money goal. And that's precisely the wrong way to go about it. If you want to trade for a living, you have to first learn how to trade without emotion. Because what happens when you try to trade to pay your bills is if you have a couple of losing trades and you're not getting to that $1,000 you need for the week to pay your bills, you're going to start making trades that you really shouldn't make. Your emotions are going to take over. So the way to trade for a living is to bucket your capital in this way. Let's say you have $100,000. 80% or maybe 75% of that you put into your long-term trading. In terms of cryptocurrency, that would be maybe 50% of that 80% or $40,000 might go into Bitcoin, and you do that over DCAing. In other words, you put a certain amount every week or every month, and you just play the long term. You might do another 30% of that 80% in something like Ethereum or some other long-term trade that you are going to use to play the long-term game. You're going to have those trades on for a year or more. So right off the bat, between 70 to 80% of that $100,000 is going to be just used for your long-term trading. Now, what you're going to do with the other 30% or the other 25%, that's where you're going to focus on your short-term trading. But either way, when you're trading, you need to be aware of certain factors. The first is discipline. So in the long term, you want to be able to have the discipline so that you're not reacting to short-term fluctuations in the market. Bitcoin can go up 20 or 30% in a matter of a few days. It can go down 20 or 30% in a matter of a day or two. So as a long-term trading, that that capital bucket that has that 80 or 75% of your capital in it, you need to just put that away and not worry about what the short term is going to do. Now, on the other hand, you need discipline for the short-term trading too, because, in short-term trading, you need to not rely on emotions and stick to your trading plan. You have a plan, you have a strategy that you're going to use. You need to stick to that. You need to have discipline in both types of trading. Next, you need to have patience. Why? In long-term trading, you need to not react to the short-term market fluctuations and to allow yourself the time necessary for your trade to play out. And that time is going to be a long time. It's going to be a year or maybe 2 years. Also, in short-term trading, you need to have patience because you need to wait until you have the right setup for the trading you want to do. Now, we're going to talk about setups in a later video, but if you want to do short-term and long-term trading, you need to develop the patience to only trade when your trading plan calls for you to trade. And then finally, you need to be able to understand your risk and understand what your risk tolerance is. So, longer term trade is really for those that have more moderate risk tolerance. In other words, you have a lot of time in the long-term trade to be able to make changes. So you don't have to worry too much about something immediate happening that's going to make you lose your money or make the trade go against you. You have a lot more time to work the trade. In short-term trading, you need to have a much higher risk tolerance because short-term trading means that you're going to do more trades. And all trades have this in common. You're going to win some and you're going to lose some. And when you're first starting out, you're probably going to, especially in short-term trading, you're probably going to lose more than you win. So you need to have an understanding of what your risk is and where you want to go with that. Okay, so we talked about discipline, we talked about patience, we talked about understanding your risk tolerance in both terms of your long-term and your short-term trading. But let's now focus on the short-term qualities, the short-term trading qualities you need if you're going to go that route. And again, long-term trading doesn't require as much effort because all you're really doing is just allocating capital as the market is beginning a bull run so that you can take advantage of that. But in short-term trading, you're going to need to do a number of things. So let's take a look at that. So what are some of the requirements? Well, the first is you need to be able to work under pressure. Because when you're doing short-term trading, you're going to be looking at the markets much more often and much more in depth than you would when you're doing the long-term cycle trades. So you need to be able to make a decision quickly because the more short-term your trading is, if you're trading on, say, a 4-hour, which is really kind of weekly trades, it's going to be a lot different than if you're trading on the 15-minute or even the 5-minute. When you get down to those lower amounts of time, you're going to have to make decisions much more quickly. And that means that there's going to be a certain amount of pressure for you to make the right decision at the right time. In order to be able to work under that kind of pressure, as we stated many times before, you need to have a trading plan. You need to have a trading strategy. And if you're starting out, you just start with one strategy, your plan, and then just follow that. That will enable you to make the decisions if you have to make it quickly. Second thing, you need to have a trading plan, just like we said. So many times short-term traders fail because they don't have a plan in place. When you don't have a plan in place, then you don't have your emotions in place. Because what happens is you're going to start trading with your emotions. If you have a good run, you're going to up your position size. If you have a bad run, you might up your position size to make up for it. You're going to make a lot of mistakes due to your emotions getting in front of what your trades are. So you have to have a trading plan. The third thing is not having an edge. Now, what do I mean by that? Well, basically, having an edge is using your strategy and testing your strategy by back testing so that you know that on the whole, your strategy will have more winners than losers. It's really quite simple. You want to look at what your trade is going to be and go back in time and find setups, at least 20, 30 setups for that particular trade, and then see how the trade goes. Once you know that on the majority of time you're making money on that trade, that's your edge, and you start trading on a short-term basis. You start trading with that strategy. Number 4 is proper risk management. You can't do short-term trading unless you know where you're going to get out and where you're going to stop the trade. So you have to put in place before you start any trade your risk management. And that is, you need to know when your trade is going against you and it's time to get out of the trade. And you also need to know what your profit levels are. And again, we've talked about this in previous videos, but having poor risk management is one of the ways that people lose when they try to do short-term trading. Number 5 is overtrading. And overtrading comes really because of emotions. It happens because you don't have a trading plan set up. You don't have a system in place and an edge for your trading, and you're not just becoming like a robot and just trading your trading plan and trading the trades that you've decided to start with. Overtrading happens because you lose on a certain amount of trades, or you win on a certain amount of trades, and you try to adjust what your strategy is. When you adjust your strategy during your trading, that's when you're overtrading. So you can't do that. You need to just follow your plan. And then number 6 is not having enough experience. And by experience, what I mean is not experience as a trader. Everybody's going to start out with very little experience. But by experience, what I'm talking about is not practicing what your trade is going to be. Practicing the trade on paper first. Backtesting helps with that. You can go back in time. You can look at the trade setup that you want to focus on. And you can take those trades one by one, see how they work out. You're practicing the trade. When you don't have enough experience, you're not going to be able to take the trade when you need to. You're going to hesitate, or you're going to take too many trades. And then the final thing is really not having enough capital. So the way that a good rule of thumb, I should say, for doing short-term trade is let's go back to the $100,000 example. If you had $100,000, you're going to put, say, $70,000 of that into your long-term trade. That's going to leave you with $30,000. Now that $30,000, what you're going to want to do is you're going to only trade 1 to 2% of that $30,000 on every trade, especially when you're first starting out. So 1% of 30,000 is $300. So between $300 to $500, that's going to be how you start off. And you want to make sure that you have enough capital to at least do $100 or $200 on a trade, as if you're going to start doing short-term trading. So in my mind, there's probably a minimum of about $10,000 that you need in order to be effective in starting to do short-term trading. You can do it with less, but that's going to give you that $100 to $200 to $300 trading for your short-term trading. So those are the things you need to do short-term trading. And again, just to summarize, what we're talking about here is really how to bucket your capital so that you can make the most money in trading. We're at a great position now in terms of cryptocurrency. We're at the transition year. This is 2023, September of 2023. We're at the transition year. We're going to be starting a bull run probably within the next 3 to 6 months, a confirmed bull run. So now is the time to start studying this, to start getting ready. Whether you're going to do just long-term trading or short-term trading, you need to have these things down pat so that you can get started. That's all for today. If you like the content, please give us a like and subscribe, and I'll see you next time.